if you treat your tax burden like a profit center, then you will be poised or positioned to be significantly ahead of other business owners. Tax credits like gold, deductions and depreciation are like bronze. That's $333,000 that you don't have to pay because you didn't take assignment of income of your sale. You took the $1 million through an intermediary into this trust. We can get people into solar projects for as little as $100,000.
All right, Mark, let me get this straight. You show entrepreneurs and folks how to save 30 to 60% on their taxes, but you don't ask them to change CPAs or strategies. Like, that doesn't make sense. So like, keeping the same CPA, how are you going to help people save 30 to 60%?
I love that question, Chris. We get it a lot. And that's really what's been the driver of our success. We don't step on toes. I like to use the analogy. If you go to a general practitioner for your health, which most people do, when that general practitioner sees an issue that needs to be addressed by a specialist, they send you to the specialist. They send you to the neurologist. So your CPA is a general practitioner, but because they don't send you to a specialist, you're not taking advantage of tax savings that are there. Why do they not send you to a specialist? Because most specialists in the financial world also do bookkeeping, tax prep, and tax filing. So why would you send your client to a specialist that will take your business away?
Yeah, that's a good point.
So that's where we stepped in and we said, we know there's a opening, there's a void in the marketplace for groups that do specialized tax strategy. And it is an area of planning that's outside of the scope of your average CPA enrolled agent. And also, if you're a RIA, because we have a lot of business comes to us from RIAs, you don't have the bandwidth to explore this area. And you might even have some regulatory oversight that would disallow you to essentially share in revenue or do anything like of that nature. So that's really where we kind of planted our flag. We are the add-on, we're the additional bandwidth for forward-thinking financial professionals and also for forward-thinking CPAs and tax professionals that know that there's additional opportunities, but they just don't have the time to explore them and they don't have the ability to implement them.
Well, after we're done with this, I want to connect you with Stefan, who runs PMC Wealth Advisors, which is our RIA, because they're always talking about tax planning, folks. And, we meet with so many CPAs, so many clients that have CPAs, and the CPA literally just files tax returns at the end of the year. I just met with a gentleman who comes from a multi-billion-dollar family, and they run a very large company. And I was just going through asking him basic questions. He wasn't using cost segregation, and he had properties. He wasn't writing off his jet. There was so many low-hanging fruits that he wasn't doing. And I'm like, dude, like, what the hell are you doing with this CPA? Well, she's helped us in our family for years. I'm like, yeah, but you're paying millions of dollars in taxes that you could be diverting over to your private banking system. Come on, man, wake up. But like, here's the thing too. And I want to make sure before we get too deep into this, I want to say thank you for your service. I know you were a Marine Corps sergeant, and that's got to add some discipline to your life. I got to think that the way you handle things, a lot of that is from what training you got is, in the Marine Corps. So talk a little bit about that. Like, how did you go from Marine Corps to doing tax planning?
That's a great question, Chris. And thank you for just acknowledging that. And it was an experience that I had. The Marine Corps, anyone that's been in the Marine Corps can tell you, I mean, it is a brotherhood for sure. And you learn a lot. And there's discipline and resourcefulness. And I'll tell you, and if anybody sees this instead of hearing it, you'll see my background is a little interesting. We lost power in our home about 14 minutes before meeting with Chris, and I had to be resourceful. I knew my batteries were out on my computer, so I turned on the car, drove up to the end of the property. We live out in the country in North Florida, got all the hot spots on, and now I'm in the field, doing the planning in the field, Chris. So thank you for that. And, just to answer your question, it's interesting because in the Marine Corps, I also, when I transitioned from the Marine Corps, I went into health and wellness That was my undergraduate work at the University of Florida, my master's work in sports management. I actually managed high-end health clubs in New York City and Los Angeles for a number of years. And in that process, I became a good operator. I really became a good operator, but I was running other people's businesses. So I was driving revenue, managing expenses, increasing EBITDA margins, and that's how I was compensated based off of the profitability of each unit or each club that I would be assigned to. And over time, I realized I'm not really going to maximize my income potential running somebody else's business, but I really understand how business owners think. So I became a consultant to business owners more in the insurance space initially. This was years ago. But if anybody knows anything about insurance, you know about tax efficiency, right? Insurance has a significant amount of tax efficiency, but I realized in that journey, there's way more tax efficiency out there than just insurance planning. So that's where I made a transition about a decade ago to really serve this market. So going from, Marine Corps and, exercise physiology, bachelor's, master's in sports management, managing high-end health clubs in large cities, to consulting with insurance, to now what I call blue ocean in 76,000 plus pages of tax code. There's a lot of coupons in there.
Coupons. I like that. Let's clip those coupons.
Send out. Yeah, they don't send out a flyer every week. They'll let you know what's available. So
I gotta wonder how many of the folks that are going to watch this episode actually still clip coupons, because our grandparents do it. Like I grew up in a family of coupon clipping. Like my mom had one of those little plastic like organizers, and she had all the coupons. So when we went to the grocery store, the only damn thing we bought was stuff that she had coupons for. But like you've got those coupons for the IRS code. So that's what we got to get into, because listen, I've been self-employed since I've been 16 years old. And I will tell you, for the major majority of that time frame, I used CPAs that filed my tax returns, and I would ask questions about like things that I would pick up at webinars or pick up at masterminds that I would go to about like tax savings. And they'd always kind of be like, oh yeah, we could do that. Wait. We could, or we are going to, because there's a big difference between could and let's get this shit done, because I'm sick of paying the government money. And I paid a lot of extra taxes over the years because, gosh, me and my wife, with our real estate holdings, we've done hundreds of real estate deals and flips and rentals. And it's kind of funny. Never once did any of those CPAs recommend cost segregation studies on the rentals. Never once did they talk to me about how they were doing depreciation and could they maximize that. But they always just did straight line depreciation. They always never really got into the weeds about what deductibility we had on these. It was just like whatever the fastest path to them get a tax return done is what I got. I can't even imagine what I lost in taxes that I had to pay that all could have been diverted over to my private banking systems with, that we use the infinite banking concept for. Like that would have changed my life really. But let's get tactical here. Good word for this one. Let's get tactical about cash flow, capital velocity, and also control of money and how you help business owners. And also I want to define who you work with, because obviously there's a lot of people that are going to watch this that maybe you can't help, but let's get strategic about what people need to be doing so they don't have to give the government more money or coupons for the government taxes.
Your point, it's there's a lot at stake here. Taxes are high. And if you treat your tax burden like a profit center, then you will be poised or positioned to be significantly ahead of other business owners. So that's where we go. We say, listen, don't just pay the tax at the bracket that the CPA says your blended rate is. And did you get all your expenses covered? And have you bought anything for the business that maybe you need or maybe you don't need? Because we're not in the business of buying something for $1 that saves you 37 to 50 cents. 50 cents being in California, 37 being in Florida. So really, it's about strategy. And to your point, every dollar that you save using a coupon or a strategy that actually implements the tax code efficiently is a dollar you get to keep in your either business account or your personal account, and you can use that to recapitalize your business. Or I like the infinite banking too. Put it into an insurance vehicle. You never pay the tax again. So you're basically funding a tax-free bucket with tax savings. So that's really kind of our
I like
mantra,
that.
whether or not they put it in infinite banking or not. But the idea is that if you can reduce your taxes by 50% or more every single year, you don't have to be aggressive in the markets to beat the pants off the other guy that's paying full taxes and trying to get 10 to 12% in the market. You can get 5% in the market and crush it.
So I just came up with this idea based on something you said. I don't think I would ever get it through compliance, but like we do a webinar jointly and I say, join us for this webinar. Learn how to have the government and the IRS fund your infinite banking concept.
I
I
love
don't
it.
think compliance will buy that, but
Yeah, I have a problem.
like we always talk about like, saving money and, we'll be specific about the privatized banking, because that's what we do. But, you're not saving more money. You're not working harder or longer. You're just shifting where the money comes from and where it goes. You're changing one thing. And it's kind of like what you're talking about. I see this because you're talking about why are so many people paying so much in taxes that they don't have to. That money could have been shifted over to whatever they want. Their IRA could have been shifted to their IBC policy, whatever. But like that is pretty logical in thinking, but most people just don't know how to do that. But I will also be honest, most CPAs that they just push paper. I don't mean to be rude, but most CPAs, they're super focused on compliance, which is good, but that makes them non-strategic. The CPA I work with now is very expensive, and I'm sure you know a lot of these kind of CPAs. Tax planning expert, works only with high net worth individuals. He's the best CPA I've ever worked with, but I would guess 90% of the business owners out there wouldn't be able to afford a CPA that does that level of planning for them. So I'm not saying my CPA doesn't work for everybody, but I don't think they'd want to pay him what he charges. So like you're providing alternatives because you're not saying replace your CPA. You're saying, let us just give you the strategy. The company name is perfect. Tax Wise Planning, or Tax Wise Partners is the name of your company. But like that's perfect. It's Tax Wise Planning. I love it.
We wanted to strategically align with our true client, which interestingly enough, our client is the CPA. Our client is the enrolled agent. Our client is the registered investment advisor that wants to add more value for their client. We know that in tax planning, you don't just you don't just have a random conversation or even a marketing based conversation with a high income earner, and they're going to change their whole world around with regard to their tax planning without it coming from somebody trusted first. So we go that route because we build trust with them. Now, here's the thing. Every 10 CPAs we talk to, there's only one or two that are like singing the song. Yeah, this is phenomenal. This is what I've been looking for a long time. There's another 2 out of 10 on the bottom side that are saying we don't do anything but mortgage interest deductions because everything else is illegal. And you're like, what are you talking about? and then you've got the 6 in between that if we give them enough education, they're going to move and start introducing us. But here's where it comes down to: we have a lot of things we can do. We can work with high income earning W-2. We have a lot of Silicon Valley clients that are engineers and executives. They make $500,000 in salary, but they make anywhere from $500,000 to $3 million a year in RSUs, right?
Dude, we
Restricted
got to
stock
throw
units or
pilots in that
non-qualified.
mix too. Like you probably work with pilots. Pilots get
Oh, sure.
screwed because they make a ton of
Absolutely.
money and they have no deductions. None.
Absolutely. I mean, whenever you're getting that big W-2 and bonus, I mean, your employer is taking all the tax benefits. You are stuck with the bill. But interestingly enough, we have a number of things that we can do, but I like talking about the 1-2 punch. And the 1-2 punch is we use generally in most cases, whether you're W-2 or you're a business owner, and we're looking at active income, right? Because we have other things we do for capital gain. But for active income, we lay a base of solar down. And even with the one big, beautiful bill that is not favorable to solar, we still have 5 more years of solar. A lot of people don't know that. If you know the solar business, you know that you can lock in 5 years more of solar with safe harboring, which we've done because we know that it's a.
When we get into solar, I also want to ask why solar and not oil? Because oil is very favorable for the new tax bill. So just make sure we cover that too.
Absolutely. And I'm not saying that oil is a bad play, but what we do is tax equity planning. We say when we're guiding you and giving you recommendations and doing analysis work and customizing your plan, we're going to show you every dollar you spend this year is going to give you more than $1 of tax savings this year. That doesn't work with oil and gas, right? You put a dollar in oil and gas, even with the IDC, you're going to get 80 cents of deduction, but that saves you, depending on your tax bracket, maybe save 30 to 35 cents. So every dollar you put into oil and gas, you save 30 to 35 cents out of the dollar. You're still 65 cents in the hole. So you better hope that your oil and gas operator produces, right? So it's good as an investment that offers tax efficiency. It's not a tax equity plan. When we tell someone to go into solar, we create a turnkey business for them. They originate tax credits. They also get a substantial amount of depreciation. And oh, by the way, federal government, one big beautiful bill says 100% bonus is back, baby.
It's really important that we define the difference between a tax credit and a tax deduction. I will tell you, the majority of the people listening to this probably do not know the difference. They just think, oh, it's tax deduction or tax credit. Tax credits are so much more favorable. Do you want to just hit on that just super quick?
Tax credit is like, tax credit's like gold. Deductions and depreciation are like bronze, I would say. Why? Because tax credit, you have a $1 tax credit, it offsets $1 of federal tax. And if you get the right tax credit, it can carry back 3 years. So if you have a tax credit that you can't use this year, you can go knock on the door and say, give me a refund for 2023 taxes I paid, overpaid. And they pay you the refund and they give you interest for the amount of time that you basically paid them and then you get paid back. So tax credit are the holy grail of tax planning, but depreciation and deductions are fantastic. The question is, can you get them in an optimized way? Like, for example, $1 deduction is going to reduce your taxable income by $1, or $1 depreciation is generally going to reduce your AGI by $1. If you're in California at the highest tax brackets, well, that dollar just saved you 50 cents. But did you spend it on something you really needed? Well, what if I could give you $1 deduction for 20 cents?
Mm-hmm.
Well, that's pretty interesting, because last time I checked, $1 deduction saves the California income earner 50 cents on the dollar. And if they pay 20 cents for $1 deduction that saved them 50 cents, that's a 30-cent arbitrage. Do that for as many, obviously if it makes sense, it makes dollars. If it doesn't make sense, it doesn't make dollars. So, those are the things that we look at. How can we give someone more tax savings than the outlay that they have, right? So when we're looking at their quarterly estimated tax payments or their W-2 withholdings, and we plan for them in Q1, Q2, we know that they're paying 60% less in tax. Just redirect your income towards these strategies, because why would you pay the government and then ask them for a refund next year when you know that you don't owe the tax? So liquidity wise, if you're making quarterly estimated payments and you realize you're originating this much solar and you're also doing some other strategies that will give you deductions, optimized deductions, well, you don't need to be paying that money in. Shift it over here at a lower amount, and the delta is yours to keep. So now you have more net operating income. So it's a really powerful conversation. And it starts at, I'd say, $500,000 of income or up. That's on active income. If you have $500,000 of AGI or more, that's when the conversation starts. I mean, we can do it with 400,000 or so in California and New York and, Hawaii, et cetera, Connecticut. But generally speaking, active income, $500,000 or up. But if we want to start talking capital gains, if you got a triggering event where you're going to pay taxes on at least $1 million of long-term capital gain of net income, we can help you there too. So you don't have to have a bunch of active income year over year. If you have a capital event where you're looking at a pretty big tax bill, we can help with that as well. It's a different scenario, but we can help.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action, like so many others have, by going to privatemoneyclub.com and sign up.
I'm sure a lot of people listening on here are high income earners, high net worth. And, hearing that, listen, if you got, we're all going to pay taxes. You can't get around that. But if you had something that you could put $1 into and get I'll just use $1.20 in deductions or $1.20 off of your tax bill, like that's a kind of a no-brainer. Like that's like I mean, let's put it into a return standpoint. That'd be like getting 20% return on your money. And the best part is you're getting that return on money that isn't going to be yours if you don't do something about it. That belongs to the IRS, whether you like it or not, whether you worked hard for it or not. The IRS is taking claim because you've got a silent partner and you can't get rid of them. You can't. So you better learn how to work with your silent partner, have some sidebar discussions about how you're going to pay your silent partner less money because they're just a slacker doing nothing and not doing anything good with the take of the money they're taking. Like this is where we got to get really in the weeds about it. And I love that you're talking about W-2 because most of the people that we talk to, tax planners, CPAs, like when I mention W-2, they kind of sit back in their chair and they're like, oh, well, there's not much we can do with them. But you're saying the opposite. You're saying, oh, there's quite a bit we can do with them.
A lot of our clients are W-2. Why? Because there's no other option for them. And to your point, I always have that conversation, particularly with business owners. You've got a partner that's taking 37 to 50% of your profit every year, and they're not doing a thing to help you. But they do offer solutions to reduce that tax. But to your point on the W-2, think about it this way. And people know this that understand real estate. You know, real estate's a beautiful thing because you have cash flow and depreciation. And when you mix cost segregation, you can really offset the active so people understand that concept, particularly to use depreciation and expenses to offset the cash flow that the real estate's producing. So here's where we flip the switch and we say, well, you want to buy more real estate? Own a similar business. So instead of going out or in addition to going out and buying single family residences and duplexes and small apartment complexes because you want to build a real estate empire, I'm just using this as an analogy. You know, you don't have to be a real estate professional. I'm just speaking the language of real estate professionals because we're doing the same thing with solar. We help you set up a single member LLC, disregarded. Either yourself or your wife is the manager of that, depending on the state, community property, et cetera. Somebody needs to do 100 hours of material participation. That's what the IRS rules are. We make that process very simple, right? Because we, kind of provided a lot of activities that are specific to the projects that your solar business will own. And once you've reached that 100 hours or more of material participation and nobody else in your business or that works on your business does more work than you, which we handle that, we help handle that. Well, you've just given yourself 30 to 50% tax credit on every dollar you put into that project. You're also getting depreciation. And remember that federal depreciation comes to you at a 100% bonus. So you get all of the depreciation plus all the tax credit, plus a 5-year maker's depreciation flow. And guess what? That solar project will produce income, net positive income for 40 to 50 years because solar produces energy. Somebody's buying the energy from you. Guess what? Their only other option is pay the utility company more. So you're selling your off-taker and a commodity at a discount to what they can get it for in the market. And you're cashing in every dollar you're putting into your solar business. For our California clients, we're getting $1.55 out of pure tax equity. They're literally going to give the government $1.55, or they're going to start a solar business, which we help them turnkey. And for every $1.55 that they give to the government, they can put $1 in their solar business and keep 55 cents in their pocket. And don't forget, They're going to get cash flow for as long as they hold that solar project. Not a lot of cash flow the way we structure it, but it can be. Depends on how you want to structure your solar business. But then we add cool things like, well, did you know that you can be profitable when you donate? And people are like, what do you mean? Last time I gave $1 to my church or my favorite charity, it cost me 30, it cost me
whatever the tax rate was,
to 50 cents, right? What's the bracket, right? I saved 37 cents, and if I'm in the highest bracket in Florida, but I gave my charitable organization $1 and they got to use it. It only cost me 63 cents to give them $1. Well, that's great if you're charitable and keep doing it. We need charitable people. But what if you could actually donate something that was worth $1, right? So now you get a 37-cent tax savings here in Florida, but you didn't pay $1 for it. Well, people have been doing this for years. It's called, and I'm not saying that you need to use your appreciated stocks, but you buy a Microsoft stock in 1985 for $10 and now it's worth $1,000. You donate it, you're going to get a $1,000 deduction itemized. Well, that's a $500 tax savings in California. If you paid $10 for that share in Microsoft, you just profited from your donation. right? You had a $500 tax savings for a $10 cost. Now, of course, you had to have been smart enough to buy Microsoft in 1985, but that's just donating to a donor advised fund and calling it a day. But what we do is we go out every year and we find owners of assets that have very low cost basis, and they're willing to sell their assets at just a hair above their cost basis because they need capital. So now if your client owns something worth $1 and they donate it, they get $1 deduction. What if they paid 20 cents for that? And their tax bracket is 50%. Well, they just got a 50-cent tax savings for something that they purchased for 20 cents.
Dang.
So that's the 1-2 punch.
So let's move on to a different topic. That's fantastic. But let's talk about business owners that are exiting their company. This is happening at a pretty rapid rate. And with the economy doing what it's doing and slowing, you're going to start seeing a lot more of this. People are kind of going to look out to get, they're going to look to exit at the top, and it's smart. So business owners very rarely plan for that event, that exit event. And those exit events, obviously, I don't care if it's a small business or a large business, that's a huge inflow of new monies that you're going to have to pay tax on. So how can you work with business owners that maybe are thinking in their mind or maybe already in the process of looking to exit, and how they don't have to give a lot of the proceeds from the exit back to the government in taxes? Because that's a severe issue that I see happen quite often.
Oh, well, think about it this way, Chris. I mean, you work so hard to build that business. You put it on your back, you broke your back, 5 years, 10 years, 15, 20, 30 years, you're finally ready to sell it after you've paid 37 to 50 cents tax every year on your earnings. And now you got to pay 20 to 37% of your profit on your business again. So this is where it gets fun. We can help business owners that are selling their business after they sell their business, as long as the calendar year hasn't closed out, but preferably before they sell their business. And unfortunately, their M&A and their brokerage team that's helping them sell it, they don't care how tax efficient their exit is. They just want to close the deal and get paid. Nothing against M&A groups, but they'd rather not slow down with tax strategy, because it's like, hey, that's not part of our deal. We just need to get this deal signed so everybody gets paid, including us. But let's think about it this way. If you're going to sell an asset, you're going to take assignment of income of that when you sell it. If you sell it in the name of your business that you own, or you sell it because you own it, that's assignment of income or constructive receipt. Whenever you sell something and you have assignment of income or constructive receipt, you have a tax bill. But you can have an intermediary sell something for you, and you can actually have the funds that the intermediary sells for you go into a structured entity, usually a trust. Doesn't have to be, but usually a trust. Guess what happens when an intermediary steps in and sells your asset for you, and the funds go into a structured entity, maybe a trust that you completely control? Well, you didn't take constructive receipt, or you didn't have assignment of income of that money that you sold, of that money from the business sale, but it goes into a trust that you completely control. So now you didn't have a tax bill, because the way we structure this is the value of the asset in the trust is the same value as the sale of the business. So there's no net impact to that trust. But you do need to take money out of that trust over time, because I'm assuming you're going to want to invest it and spend money, but you can invest the dollars in the trust. So now let's just say you were selling your business for easy math, $1 million. You're in California. So you're going to pay 20% federal tax. Because you're actively involved in the business, you don't have to pay 3.8 net, but you still have to pay California 13.3. So that's 33. So that's $333,000 that you don't have to pay, because you didn't take assignment of income of your sale. You took the $1 million through an intermediary into this trust, and now you have $1 million in the trust, less the cost of structuring it. And all that money is there for you to reinvest. And now you can sip the tax bill over time out of that trust, because you will pay taxes when you take money out of that trust. But that's one strategy. We have other ways to do it as well. Let's just say a business owner comes to us and says, I just sold my business. It was great. It was a great run, 15 years. I just sold it for, $11 million, and my cost basis was super low. I mean, it was about less than $1 million. So I have 10 million of income. I got this big tax bill. What can you do? Well, we always say, we wish you had talked to us a few months before you sold, because we would have reposition your asset into something that you control, and then you can reinvest in that world and take the income over time at a lower tax bracket, or even eliminate the tax depending on what you do in that trust. But if it's after the fact, we say, well, here's what we can do. We can utilize solar. We can utilize optimized charitable giving, right? Because those things actually, you buy something, you get that higher level of depreciation. Or we can put you in a new business. And interestingly enough, the new business that we put you into is fairly turnkey. I mean, there's some things that you need to do, but part of that new business gives you a negative K1, and it's disproportionate to your dollars that went in. So you, like, let's just say you have $1 million of taxable income, long-term capital gains in California, and you're going to pay $330,000 of tax on that $1 million of gain, 20 cents to the feds and 13 cents to the state. That's the 338,000. Well, what if we could get you into a business for a capital contribution of $100,000, and that partnership would disproportionately allocate a negative K1 for you for $1 million? Well, if you have a negative K1 for $1 million, then that just offset your $1 million of income.
Sure.
You only paid $100,000 to get capital contribution to get out of that partnership. And now you've got a partnership that you can keep going for as long as you want. That's like a 1031 for your business, right? It's a deferral. You don't have to pay the taxes until you exit the partnership. You can keep the partnership going as long as you want. So
one thing I want to hit on is a lot of our clients and a lot of our community, they do private lending. Private money clubs, one of the companies we created, the fintech, and a lot of them are doing private lending. Private lending's awesome. I mean, it's a great return on your money. It's relatively safe because you got the collateralized asset, and as long as you do it properly with the right attorney. Obviously, folks, you got to do your own due diligence and work with your professionals to make sure you're structuring the deal right. But the problem with private lending is there's really no write-offs. I mean, you're just taking money that you've accumulated in one source or another, policies, maybe it's a self-directed IRA, but you're lending that money out at a very good return, call it 12, 15% in some cases. And that's all taxable income coming back to you. So how do private lenders offset some of that income?
yeah, Chris, that's like, portfolio income that is treated just like ordinary income. It hits the highest brackets.
Yep.
It's really, when you look at the weighting in the tax prep, it's no different than W-2. I mean, essentially. So we use the same strategies. Let's give you depreciation and tax credit from a turnkey solar business if you're willing to operate it, and it's super easy to operate. Let's give you deductions from donations that are optimized, right? Because you're now donating non-cash assets, so you get to take the appraised value for your donation or deduction, and it just so happens we can give you the asset for a substantial amount less than its current appraised value because of our relationships with the owners of the assets. So those two things, I would say, are probably the most ideal ways to offset that interest income. We could also utilize the partnership that I just spoke about that gives a negative K1. That would also offset the income. But I think that the more conservative approach would be to generate depreciation, generate deductions that you can actually take against your active income. And it's just all about the math, right? What tax bracket are you in? Because if you're in a 24% federal bracket, and you're in Florida, right? There's no state income tax. Well, I'm not going to tell you to buy something for 22 cents to save 24 cents. It doesn't really make sense. I mean, a 2% return, I wouldn't do it.
I like the way you said that.
If obviously, if it doesn't make sense, it also doesn't make dollars. So let's not do it. But if they have a 35% tax bracket, a 37% tax bracket federal, plus anywhere from 2.5 in Arizona to 14.3 in California, so now you're looking at close to 50% of your net income being taken away from you. Well, I will buy an asset all day long at 20 cents on the dollar because I'm going to save 50 cents when I donate it. You just have to do it right. The IRS generally will scrutinize that big time. So if you're going to play that game, It's not a game. It's real. It's a real donation. It's real. You're really helping charitable organizations do what they want to do. You just have to do it right, because the IRS is in the business to collect revenue. And if they see a lot of revenue not coming their way because of a specific strategy, they will do their best to kibosh it. Ask everybody in the conservation easement space.
Yeah.
Right? But they couldn't get rid of conservation easement. Conservation easement is still a thing. You can still do it. You can even do it in syndication, but they just limited it. But you know what? You can still conserve land without using section code 178. So there's still ways to do it.
So let's get micro on the solar deals. Like, how much does somebody need like to have? Because obviously, like, you know, people have tax problems because they don't do any tax planning, but they have no money saved to do these investments into oil or solar or some of these things. Like, where does it start with the solar? Like, how much does somebody need to really start benefiting from solar, invest? I don't want to call it investing, but how would you call it? It's solar investing. Is that the way to do it?
You know, really the way that we apply this, Chris, like it needs to be an active business. So we say, why don't you become why don't you become a solar business owner? It's a fairly turnkey business. It's not like you're not going to be rolling left and right in the night sleeping, thinking about your solar business. We can make it very turnkey. So if you're willing to, actively participate in a solar business, which is only 100 hours per year or more, according to the IRS regulation, well, then we can give you depreciation and tax credit and cash flow that's greater than your dollar put into that solar business. So when it comes to liquidity, this is where quarter one and quarter two conversations are very handy, not quarter three, quarter four. We want to look forward, not backwards. And especially if it's a successful entrepreneur or even someone that's a successful executive, and they know that every single quarter they're paying these estimated tax payments, or every single paycheck they got this big chunk of change coming out as a W-2 withholding. And we say, well, if you become a solar business owner, you don't have a $170,000 tax bill. You're going to have a $35,000 tax bill. So you don't need to have this withholdings. You don't need to make this quarterly estimated payment. So now the liquidity is a little bit easier, right? Because their paychecks are bigger. They're realizing, hey, I don't need to store this money away to make this quarterly estimated, or I can make a significantly smaller quarterly estimated. And that's the money you use to seed into your solar business to ultimately acquire projects which are ready to go. I mean, we're a broker. We show our clients that here's a lot of different assets that you could buy as a solar business owner. You choose what you want to buy, but every single one of them is cash flow positive and obviously has 30, 40, or 50% tax credit readily baked in. So it's going to give them the tax credit and the depreciation and the positive cash flow. It's just a metric of how do they pay for it. And we say, pay for it with your tax dollars. How? Well, don't send the federal government and the state government money that you don't owe them. Bifurcate it, redirect it towards these projects. And you're paying less into these projects than you would have paid to the tax authority. So the delta is yours to keep.
I like this. I mean, I've sat down with a lot of people regarding solar. I have not yet pulled the trigger. We've always gone the oil way. But the way you guys are doing this, the way you're talking about it is very unique compared to the conversations I've had. Because the conversations I had, like you were playing $1 million, $2 million for some of these projects, that we were going to do. And I'm just like, I really don't want to lay that much liquidity out. The tax savings is great. And I know I'm going to be able to use that for years, but it's just like the liquidity is equally, the opportunity cost, on my money is equally as valuable. So I like the way you guys are doing this. It's very unique, but I also want to unpack how important it is. And I know people are perpetual tire kickers and perpetual kick it down the road. But if you start doing this planning in third and fourth quarter, you're already way behind. Your tax planning's got to start in the first quarter, like right now. Like here it is, February. We're almost turning into March. And this is when you start planning, but everybody, including most of the CPAs, they want to start planning maybe third quarter, but a lot of times fourth quarter. Like, talk a little bit about those two things.
Yeah, I mean, that is a very good point, Chris. I mean, I think that the planning that we do, like, let's put it this way. We can help people in Q3. We can even help people in Q4. It's not as easy. It's not as convenient. But what we do in that process is we say, let's never do this again. But that's the key. It's forward thinking. You're going to be able to save more tax in a calendar year if you start planning for it in Q1 and Q2. And a lot of that just has to do with inventory, right? What projects are out there? Because solar, you want to get the best projects, and you also want them to be placed in service before the end of the year. And if you start looking for projects in November, well, how many projects are out there that will be finished before the end of the year? Because you want your tax credit, your depreciation in the year of acquisition, but you don't get that benefit until it's placed in service. So earlier the better. And we can get people into solar projects for as little as $100,000. So we're not talking like millions of dollars. Like we can literally get people into solar projects for as little as $100,000. And then, of course, when we're talking about charitable giving that's optimized, well, that's pretty simple. You can do that in December 15th. I mean, you can literally, we can say, if they say to us, I made $1 million this year, and I'm in California, and okay, well, let's reduce your million by 300,000. Why? Well, because when you donate a non-cash asset, your deduction limit's 30% of your adjusted gross income. So we have $300,000 to work with. Great. We can fill them in November or December an asset that's worth $300,000 for, let's call it $60,000. Well, that becomes interesting because if they donate an asset that's worth $300,000, last time I checked, you're going to get an itemized deduction on your Schedule A for $300,000 because that's the value of your donation. And if you're in the highest tax brackets in California, you're saving $150,000, $140-ish because of the limits that they impose. But you paid $60,000, $70,000 for that asset. So this is where it gets really interesting. Now that's a late year planning that we can do. But again, it's the project, the people that are willing to sell assets at discounts, you can get better deals in Q1, Q2 than you can in Q3, Q4. So that's our 1-2 punch. But there's other things we can do. Yeah.
Well, all right. So as we kind of get to the end of this, I want to get into the poor soul who's sitting there right now, February 2026, saying, man, I wish I would have known about this stuff. I got my taxes due in April. What can I do now, even though I missed the boat on all the stuff I should have done prior to, December 31st? What can they do right now to still get them some tax relief or tax savings?
That's where it gets a little bit tricky because we can't get in a time, traveling vehicle and go back to 2025, right? Their planning window was pretty much over on December 31st. However, if we show them how much taxes they can save in 2026, and they know that they can start saving those taxes now, well, even though they have to stroke a check for 2025 on April 15th, they may not have to stroke a check for their quarterly estimate, right, from 2025, that's in January, and they may not have to stroke a check for their Q2 quarterly estimate in 2026. So we're now recuperating money that would have gone out. So even though they have to write the check for 2025, we can say, well, let's reduce your withholdings for 2026. Let's reduce your quarterly estimates for 2026. So now they're keeping more money. And then, oh, by the way, when we're planning for 26, we're also planning to get that money back that you overpaid in 25. But first, let's look at 2024. No. First, let's look at 2023 because we have a 3-year carryback on the solar credit. So that's really where it's almost like, you got to stroke the check for 25 because you were too late, but let's reduce taxes on your W-2 withholdings or your quarterly estimates. So that kind of makes up for the cash flow that went out. We're keeping cash flow in. And then let's plan to optimize your 2026 year to where we can have excess tax savings in a credit so we can go back and get a refund from the government for your 2023 overpayment.
Yeah, I mean, I'll speak firsthand. So a lot of the things we do, we have our estimated taxes, which are way too high. I choke every time I see what the quarterlies are. But we go hard all year and we do all of our tax planning, starting January 1 straight through, so that by the time we get to the third and fourth quarter, by our estimates, we won't have to make those estimated payments. That's like a windfall of a lot of money that I can then use other places, make investments for that year, make investments for the next year, so that's how I do it. So folks, I'm not saying, I'm not the expert here. I'm not saying do it that way, but that is definitely a way to look at it, because listen, it's either going to be, you're going to get proactive and you're going to do something and it's going to benefit you huge. You're going to do nothing and you're just going to continue to keep bitching and moaning that you're paying too much in taxes. And you know what? Burden's on you now. Because if you just listen to this and you don't get a hold of Greg and his team, you're at fault. Stop complaining. Stop whining about how much the government's taken. Do something about it. And that's the most important thing. So with TaxWise Partners, your company, how do people get a hold of you? Like, where's the best way to engage you guys, or at least learn more about that? Because I know a lot of people are listening to this are probably thinking, well, how would this work in my scenario? Like, what would they do?
So we make it really easy. If you go to taxwisepartners.com, right, just the name of our business, taxwisepartners.com, we have links for you to set up an initial consulting meeting, and that's completely free. You can speak to one of our tax savings architects. You can even click a link and actually provide some information about your situation. And when we speak to you, we can actually have a blueprint for you to look at. Hey, based on the information you provided, this is the range of savings that's available to you, and these are the types of things that you should be doing. So you literally can plug that information in without even talking to us, and we can provide blueprints. But all that is complimentary, and we just want to make sure that we're providing value. And once people really understand that there is a lot that they can do, we generally then open up the door. It's more a consultative conversation. So at that point, we're helping them craft the best plan possible. But again, we're not stepping on their investment advisor's toes. A lot of times we're introduced to them by their investment advisor, or we're not stepping on their CPA's toes because we're not going to be doing their bookkeeping, tax record, tax prep, or tax filing. All we're doing is creating additional value. The RIA will have more money to invest because the client is sending less to the government. The CPA will have more billable hours because they have to do a little bit of extra things to actually file these returns. And of course, we'll share revenue with them if they want, depending on if there's no conflict of interest, we're fine with sharing revenue. We want people to have a higher value and also additional revenue stream for their business. That's how we interact with CPAs.
So folks, what we're going to do, we're going to put taxwisepartners.com up in the description as a hyperlink. You can just click that, book a call, get on that consulting call so that you can get your blueprint for your tax strategy and what this could look like. But the other thing too, I'm going to do is I'm going to introduce you to Stefan over at PMC Wealth Advisors, because I think that is a really good fit for you as well. But Mark, this has been really great. Again, thank you for your service and thank you for everything you're doing to save people on the dreaded tax bill. It's pretty phenomenal.
Chris, thanks for having me on. It's been a blast.
Absolutely.
Appreciate you letting me just talk.
Yeah. And thanks for being resourceful and doing it, from your hot spot at the end of the road. So with that being said, folks, thank you all for joining us for this episode of the Money School Elite, and we hope to see you next time.